how does a company making steering wheels and a company making pacemakers survive the exact same economic earthquake? Because normally, a sudden global tariff spike it's basically a total death sentence for profit margins.
Oh, absolutely. It completely upends the cost structure of a business. I mean, suddenly the raw materials moving across borders are exponentially more expensive, and that comfortable predictability just vanishes overnight.
Right, it's gone. But today we are looking at two global giants who just proved that conventional wisdom completely wrong. Welcome to the deep dive. Our mission today is to decode the ultimate playbook of corporate resilience.
Yeah, we're really looking at how massive players survive and honestly even thrive when these macroeconomic shocks hit.
Exactly. And to do that, we are looking at two very recent, incredibly revealing Q1 2025 earnings calls. First, we have Autoliv, which is a massive Swedish automotive safety maker, so think airbags and seatbelts. And second, we have Abbott, the highly diversified medical device titan. So in the first quarter of 2025, they were both staring down the exact same macroeconomic threat, which was sudden sweeping global tariffs.
Right, and how they engineered their defenses against that shock, it gives you just a absolute masterclass in modern corporate strategy.
Totally. So let's start with the most immediate defense mechanism, which is just, passing the bill to someone else. I was looking at Autoliv's numbers, and honestly, despite this massive tariff threat, their profitability just looks unstoppable. Like, how are they pulling that off?
The numbers really are striking. For context, Wall Street analysts expected them to make around $1.72 per share. Autoliv came in at $2.15.
Wait, really?
Yeah. That is a massive 25% surprise beat. And more importantly, their profit margin took a huge leap. For every $100 they made, they kept nearly $10 in pure profit.
Wow.
In the automotive supplier world, I mean, that kind of profitability is tremendous.
Okay, let's unpack this. How do they expand their profit margins when they are getting hit with brand new taxes on the materials they need to build their products?
Well, management was incredibly candid on the call. They set up a dedicated task force, right, focused strictly on internal cost control and execution. But the real lever they pulled, they stated point blank that the tariffs were neutralized almost entirely in the first quarter.
Just neutralized.
Almost entirely, because they simply passed those higher costs right on to their customers, the major automakers.
That is wild. It reminds me of like a local bakery, right? If the price of flour suddenly skyrockets, the bakery doesn't just eat the cost. They instantly raise the price of a croissant the second that flour gets more expensive. Autoliv essentially told the massive auto manufacturers, hey, our raw materials cost more now, so your airbags cost more now.
Yeah, exactly. And the broader market cheered that reflex. I mean, Autoliv's stock jumped 8% almost immediately because investors saw that credible margin protection. It proves they have the pricing power to simply hand the bill up the supply chain.
But, as a long-term strategy, I do have to push back here a bit. If vehicle prices just keep rising because suppliers are passing the buck to the automakers, who then obviously pass it to the car buyers, won't consumers eventually just stop buying cars?
What's fascinating here is that the market analysts are asking that exact same question. It's the core risk read-through from an otherwise fantastic quarter.
Right.
Autoliv is demonstrating that they are much better at offsetting costs than they are at offsetting volumes. The entire pass-through strategy relies on end consumer demand remaining stable.
So they can protect the profit margin on a single steering wheel, but they can't force a family to actually go out and finance a new SUV.
Precisely. If cars get too expensive and the volume of vehicles being produced starts to drop, what the industry calls light vehicle production, or LVP, this pass-through strategy hits a brick wall.
Yeah, that makes sense.
Passing the buck is a great short-term reflex, but it leaves you totally exposed to the broader whims of consumer demand.
Which brings us perfectly to our second company, Abbott. Because, passing cost works for airbags, but healthcare requires a completely different playbook.
Oh, entirely. You can't just hike the price of a life-saving medical device overnight the way you negotiate a car part. The contracting environments with hospitals and, national governments, they're entirely different beasts.
And yet, Abbott's Q1 was incredibly strong. I saw their overall sales were up nearly 7%, or actually over 8% if you exclude COVID testing drops. And their profit per share was up double digits.
11%, yeah.
Right. But right there on the earnings call, the elephant in the room was tariffs. Abbott CEO Robert Ford was asked about it directly, and he dropped a quote that I think every business leader needs on a sticky note. He explicitly stated, hope is not a strategy.
It's a very grounded perspective. Management is projecting a tariff impact of a few $100 million in the back half of 2025. So they aren't pretending the storm isn't coming.
Right, no sugarcoating it.
Exactly. They expect no impact in the second quarter, but the real friction starts in Q3.
So if hope isn't their strategy, what is? I mean, they rely on a structural defense they've literally been building for decades. Abbott utilizes a massive framework of 90 manufacturing sites spread all over the world.
90 sites. It is the concept of supply chain redundancy and regionalization taken to its absolute maximum.
Let's look at a specific example. Their continuous glucose monitor, the Libre. This one product did $1.7 billion in sales just in the first quarter alone, and it's growing at 30% in the U.S.
Massive growth.
Massive.
Yeah.
But to protect that revenue, Abbott doesn't just make it in one mega factory overseas and ship it across the ocean. They have 6 global manufacturing sites, specifically for the Libre, and 2 of those sites are located right inside the United States, explicitly to serve U.S. demand.
And that is the structural moat. By aligning their manufacturing as close as possible to the end customer, they drastically reduce the amount of product crossing borders that are, suddenly subject to new taxes.
But I have a logistical question here for you listening, because it's something I was wondering while digging through their balance sheet. Abbott has massive cash reserves, right?
Oh, yeah.
So if tariffs are coming in Q3, why not just use that huge balance sheet to run your overseas factories at 200% capacity right now and hoard a massive mountain of inventory before the taxes actually bite?
If we connect this to the bigger picture, Abbott's management directly addressed that exact temptation. Building inventory is a classic short-term Band-Aid. But what happens in 2026 when that warehouse is finally empty?
You're right back where you started.
Exactly. Management pointed out that tariffs historically rarely go away. They cited the tariffs implemented back in 2017, they're still active today.
Wow. Okay. So you really have to treat it as the new normal, not just a temporary storm.
Exactly. True mitigation requires structural alignment. By having those 90 global sites, Abbott physically matches their infrastructure costs to their revenue on a regional basis. And what's brilliant is that this physical footprint also acts as a natural foreign exchange hedge.
Oh, wait, explain how that works in practice. Like, what does that look like?
Sure. So if you manufacture a medical device in Europe but sell it in the US, you are entirely at the mercy of the exchange rate between the euro and the dollar. If currency values swing wildly, your profit gets wiped out just in the conversion.
Oh, I see.
But if you make the product in the US, pay your factory workers in US dollars, and sell it to US hospitals in US dollars, you insulate yourself from those global currency swings entirely.
Okay, that is brilliant. So Autoliv plays defense with lightning fast pricing power, and Abbott plays defense with this deep, localized physical footprint. But you can't just play defense forever. To truly survive, you have to outgrow the headwinds. Both of these companies are utilizing rapid innovation as their ultimate moat.
Because true pricing power doesn't actually come from clever negotiation tactics or, just demanding more money. It comes from making your product technologically indispensable.
Right.
If you have the absolute best, most necessary product on the market, your customers will find a way to absorb the friction of the macro environment to get it.
And we saw this vividly with Autoliv. Despite all the geopolitical uncertainty, automakers actually increased their sourcing orders for Autoliv's new safety products in Q1.
It really highlights a fascinating dynamic in the auto industry right now.
Yeah.
Automakers are designing their future vehicle platforms, and they are terrified of falling behind on safety ratings. They know they need Autoliv's newest, most advanced airbag systems and steer-by-wire technologies. The demand for that future innovation just overrides their reluctance to pay higher prices today. They simply cannot build a competitive modern car without it.
Here's where it gets really interesting. Abbott takes this concept of indispensable innovation to an entirely different level. I mean, their medical devices segment grew 12.5%, fueled by some truly futuristic technology. Let's look at one specific product driving their rhythm management division, which grew 6%, the Aver leadless pacemaker.
Oh, the adoption rate on this device is staggering. Monthly implants by early adopters increased by 30% recently.
Wow.
Management explicitly views this as a total standard of care shift.
Yeah, think about the jump from landline telephones to smartphones. It wasn't just, a slightly better landline with a longer cord. It was a fundamental change in the category that made the older technology completely obsolete, regardless of price.
Right, total new paradigm.
Exactly.
Yeah.
That is what a leadless pacemaker does. It fundamentally alters the surgical implant technique that cardiologists have used for decades. You don't have wires running through veins anymore. It creates a completely new baseline for what a patient expects.
And they're doing this across multiple specialized divisions. In electrophysiology, which by the way grew 10%, they have a system called the Volt Pulsed Field Ablation, or PFA. It just received CE mark approval in Europe much earlier than expected, and they are eyeing US approval in early 2026.
And what makes that one so special?
It uses this highly unique balloon design that provides incredible stability during delicate heart procedures. When you release technology that drastically improves patient outcomes like that, hospitals are essentially forced to upgrade.
They don't really have a choice.
Exactly, and the list goes on. In structural heart, which surged 15%, their TriClip device just showed incredible 2-year trial data at the American College of Cardiology. It significantly reduces heart failure-related hospitalizations.
Wow.
In vascular, they're enrolling a U.S. pivotal trial for a new intravascular lithotripsy system, or IVL, to treat severe coronary calcification, which is a $1 billion market.
Yeesh.
They even began the Transcend trial in neuromodulation, using deep brain stimulation for treatment-resistant depression.
Okay, but this raises an important question. Well, wait, let me use your catchphrase.
Go for it.
How on earth does a company maintain this blistering, aggressive pace of research and development while simultaneously dealing with the margin squeeze of tariffs and inflation? I mean, usually when macro conditions tighten, R&D is the very first thing a CFO cuts to save money.
This raises an important question indeed, and you're completely right. Launching a parade of brand new medical devices requires massive capital. So how do they afford to keep the labs running? The answer lies in their underlying operational efficiency.
Okay, so tightening the belt elsewhere.
Exactly. In the first quarter, Abbott actually expanded their gross margin by 140 basis points. Or, to put it plainly, they increased the percentage of pure profit they keep from every single sale. They have a relentless focus on leaning out their administrative costs and supply chain inefficiencies.
So they're funding the future by optimizing the present.
Precisely. That strong underlying engine is what funds this massive pipeline of 25+ key new product launches over the next 3 years. They are proving that you can expand your profit margins and fund aggressive R&D at the same time, but only if your underlying operations are incredibly lean.
It really is a masterclass in execution. But, as we've seen in these earnings calls, even with perfect pricing power, and even with incredible category-killing innovation, there are certain geographic realities that simply cannot be out-engineered. For both Autoliv and Abbott, the shared hurdle is China.
Yeah, China represents a highly unique macroeconomic environment right now. The dynamics there defy standard mitigation strategies, and both companies felt the impact heavily in Q1.
Let's look at the facts here. For Autoliv, China was their main mix headwind. Now, to be fair, their sales to domestic Chinese automakers actually grew 19%, which sounds like a massive win, right?
On the surface, yes.
But Autoliv still underperformed the broader market there. Why? Because right now in China, consumers are shifting rapidly toward cheaper, lower content vehicles. So those lower content cars are outgrowing the higher content vehicles that Autoliv actually supplies.
It's a massive market mix shift. Autoliv supplies high-end, complex safety features, but the production of those higher content vehicles is being outpaced by the production of basic, low-cost cars that just require fewer airbags and less advanced safety tech.
So they're winning the accounts, but the cars being sold aren't the ones packed with their best gear.
Right. Autoliv is selling to the right partners, but the end consumers are buying the wrong type of car for Autoliv's premium product line.
And for Abbott, the China dynamic is even more complex. Their overall diagnostic sales were down 5%, which, was largely due to the expected drop in COVID testing. But even in their core lab diagnostics business, China was a massive drag. This is because of something called VBP, or volume-based procurement programs.
Yeah, VBP is a critical mechanism to understand if you're looking at the Chinese healthcare market. Historically, the government institutes VBP to drive down medical costs. You, the manufacturer, agree to take a massive price cut on your medical device.
Right.
But in exchange, the government guarantees you a massive volume of sales, so you make significantly less profit per unit, but you sell millions more units.
It's a trade-off. It hurts your profit margins on a per-item basis, but it protects your overall revenue.
Exactly. That volume offset is exactly why VBP normally works for big players. However, Abbott noted that in this specific recent VBP cycle, something highly unusual happened. All the manufacturers decided to stay on the market and maintain their contracts.
Oh, wow. Meaning Abbott took the severe price hit dictated by the government, but they got absolutely zero volume offset because they were still splitting the market with all of their competitors.
Correct.
That sounds like an absolute worst case scenario for a regional division. A direct hit to pricing with no volume buffer to soften the blow.
It is immensely challenging. So how does Abbott react? They pivot their capital. They're dropping $500 million, $500 million, into brand new manufacturing and R&D facilities in Illinois and Texas to expand their U.S. transfusion diagnostic business.
Just totally pivoting the investment.
Yep. They are launching the Alinity N system for nucleic acid testing, which screens the blood supply for diseases, and that's a massive billion-dollar market opportunity right at home.
So what does this all mean? I have to ask this for you listening because it feels like a contradiction. If both an auto parts giant and a healthcare titan are struggling to crack the current Chinese market dynamics, despite all their resources and innovation, is regional diversification actually enough to save your margin?
That is the core tension right now. And what's crucial is that neither management team is throwing in the towel. They are holding the line.
Oh, really?
Yeah. Autoliv is publicly stating they expect a significant improvement in their China sales performance in 2025 as new vehicle launches ramp up in the second quarter. They are betting that the product mix will swing back in their favor.
And Abbott. Because that VBP situation sounds brutal.
They aren't abandoning China either. Abbott is executing a masterclass in global dilution. Yes, the China VBP hit them hard, but they balanced that out by growing their core lab sales 6.5% everywhere else in the world. They grew heavily in the US, across Europe, the Middle East, and Latin America. They aren't abandoning a tough market. They are using their immense global strength to dilute the negative impact of that single region to a highly manageable level.
It really is a fascinating balancing act. All right, let's bring this all together. Today's mission was to extract the ultimate corporate survival guide for navigating macroeconomic shocks. And looking at Autoliv and Abbott, we can distill this down into three distinct pillars of resilience.
Absolutely. Pillar one is swift execution and cost pass-throughs. As Autoliv showed, when raw costs spike, having the pricing power to shift that burden up the chain is the ultimate short-term shield.
And pillar two is deep, redundant, localized supply chains. Abbott's 90 manufacturing sites prove that hoping for favorable trade policies is a losing bet. You survive by matching your physical footprint to your regional demand, which neutralizes tariffs and foreign exchange risks simultaneously.
And pillar three is relentless, category-killing innovation. Whether it's Autoliv's advanced steer-by-wire tech or Abbott's Avere leadless pacemaker and Volt PFA, if you innovate at a pace that fundamentally changes the baseline expectations of your industry, your product becomes indispensable.
And that grants you the ultimate leverage to weather almost any macro storm. And, this matters to you, whether you are managing a small business, balancing a stock portfolio, or just trying to understand the evening news. These earnings calls prove that reacting to a massive economic shock isn't about panicking. It's about balancing those short-term levers, like contractual pricing adjustments with long-term structural moats, like physical infrastructure and deep R&D.
It requires a dual vision, really, managing the immediate crisis of this quarter while physically building the architecture for the next decade.
Which leaves us with a pretty massive thought to chew on as we wrap up. If ultimate corporate survival now relies on hyper-localized manufacturing and highly regionalized supply chains, building products in the U.S. explicitly for the U.S., and building products in Europe explicitly for Europe, what happens to the very concept of the global multinational corporation over the next decade?
That is the trillion-dollar question.
Right. Are we witnessing the slow, quiet end of globalization as we know it, only to be replaced by a series of insulated, self-sustaining regional empires?
It certainly seems like the era of a single, borderless global supply chain is fracturing into something far more compartmentalized and, frankly, fiercely protected.
It really makes you rethink the entire architecture of global trade. Maybe the future isn't about perfectly optimizing one massive interconnected web. Maybe it's about building regional fortresses that can stand entirely on their own. Thank you so much for joining us on this deep dive. Keep questioning the consensus, keep looking at the fundamentals, and we will see you on the next deep dive.